Hello YouTube, this is Haperdada. I will be your host today to help you out on how to do long-term investing. So as you can see, what happens is in schools here is that nobody teaches you how to invest. You go to school, you go to high school, you go to college, and hardly anybody is going to teach you how to invest. So where do you learn this stuff? You learn it from friends, family, in parties. You get stock tips. And then what happens eventually? One day you realize that you're not making money, you're wasting time in the market, you're providing liquidity to the Wall Street. So, what are you going to do then? What are you going to do, my friend? What are you going to do? So, you come to YouTube and you look for how to be a good long term investor. And that's why I created this video for you so that you could get some ideas on how to be a successful investing long term. This is not a video about short term investing. This is not about a video about getting rich quick in the market tomorrow. So hold on your strap and let's begin. Goals for investing. We start with the goals. If you don't have any goals for investing, why you're in the market? Obviously, you have some goals. If nothing else, you're just having fun gambling like a day trader. Or maybe your goal is like build a nest egg for retirement, funds for children's education. It could be down payment for a home. It could be travel across the world. It could be live comfortably and pursue interesting activities. It could be other goals, charitable causes. So these are all the goals that you can have potentially. And depending upon the goal, your portfolio allocation will matter. What these goals are actually some kind of input in your portfolio building exercise. And one of the other things that you can see from the goals is it tells you the time horizon, which is a very important thing to have in mind when you're trying to invest. Because if your time horizon is too short, you should probably stay away from stock market and maybe just go with what your daddy told you as the savings account, the CDs, the fixed deposits. Anyway, so let's go to the next slide here. We've got investing dilemma. What is the investing dilemma nowadays? The Fed is not paying any interest rates at all. What is Fed doing? I'm sorry. Let me back that up. No, the Fed doesn't pay interest rates to you, sir. What happens is the Fed sets the Fed funds rate, and as you know, it has been very low, and that goes into the prime rate and all the other interest rates in the economy. And as you already know, the banks are hardly paying anything these days. The banks pay just if you go and take your $10,000 to your bank or $100,000, what kind of interest rates do you get? You will be very lucky if you can get 1 or 2% on a CD. Even forget about regular savings account. So, so then what do you do? Then you come, okay, I have heard of stocks, I have heard of bonds. Should I invest in stocks or should I invest in bonds? I've also heard of real estate. And then there's like the commodities. They call them gold, silver, all the different kind of commodities that you see. Fine arts and other collectibles. That's another. Usually these things. You will find that the big guys, the hedge fund, a lot of money, the rich people, they would be investing in these fine arts and other kind of collectibles. So now let's go back to the second slide, which is current investing environment. This is a very important point to understand, by the way, sir. You got to understand what is interest rates historically low. What is the current investing environment? Is it 2008, immediately after Great Recession, or is it 2019? The market is at all-time high. Interest rates is still very low. Oil prices not very high. Bond markets also is historically high because of interest rates being too low. The real estate markets also right now is super high, and it has come a long way from the lows of Great Recession. Now we come to the next slide, which is investing dilemma. So so now coming back to the next slide, which is choice for an individual investor. What are my choices as an individual investor? Have you ever thought about that? So my choices could be Do it yourself, or my choices could be hire a professional money manager. Now, when you hire a professional money manager, then what happens is that you're getting always fleeced by these guys. They will always try to sell you something, and then many of them are good. I'm not trying to say they're all bad, but some of them are also trying to basically send you commissions, load mutual funds, and things like that. So you don't want those kind of guys. You want the genuine guys. So let's go to the next slide. Do it yourself first. Getting an investing acumen takes a long time to develop. Need to have good understanding of macroeconomics and markets. What does that mean? Have you ever had a, you've been wasting all your time on Tinder, but you never even went into you must have gone to Whole Foods or Safeway hundreds of times, but it never occurred to you that hey, there's a Barron's, there's a Wall Street Journal, there are like bunch of other papers with some financial news and all, but you never even had like once when you went and took a look. So then and then you say, oh, I don't know anything about investing, and all I'm doing is investing based on some hunch or what my friend told me, and then the end result is not much to show because you do not have the concepts of long-term investing clear in your mind, and that is why I'm here to help you out today. A good discipline for staying the course on long cost long-term investing is required. You don't want to like, hey, I invested last month and now I'm checking my stock every day, and then oh my god, it went down because of some short-term events like Brexit, and then hey, I will just get out, but I'm because I can't just take this. Well, I can't handle the volatility in the market. Now, rebalance or buy and hold. This is another one of the things that I will come to later, but right now you just want these things in your head. I want you to be able to at least know the jargon. What is rebalancing? What is buy and hold? They are the different methodologies for the long term investing. But let's take one step at a time. So let's go to the next slide. On the other hand, if you're not a do it yourself, then you can decide to go hiring professionals, which is basically an investment advisor. And most of these guys are basically, if you find, you will see that they're all, in order to be an investment advisor in the state of California, you have to be registered with the state before you can charge money for investment advice. You could not give investment advice and charge money for that advice without being a registered financial advisor. There's an exam for that. Many they have to take Series 65. So unless you are Series 65, forget about it. You cannot. You can give probably free advice, and that's all you could do. So now this is a very highly regulated business, and look for licensed financial advisors always, always. Also, there are two kind of financial advisors, by the way: the commission based and the fee based. The commission based, what they would do is they would try to stick to you some load mutual funds, and you say, "Wow, this financial advisor is not charging me any money," but you don't realize that he's getting a lot of commissions from the mutual funds or the investment vehicles he actually suggests for your portfolio. So that's why it's always good to go with the fee base, because there's a there's something called fiduciary duty that all financial advisors have to go. That means they have to put the interest of the client before their own interest. So that means a fee base, they just charge you upfront like 1%. They just tell you that we'll charge you up 1% of the assets that they manage for you, and then they just go and should try to find you mutual funds or investment exchange traded funds with very low expense ratios and no load mutual funds, hopefully. Now, certified financial, I will come to load and no load thing later in the presentation. Now, coming back to the certified financial planners can do estate planning too, by the way. Let's go to the next slide. Basics. So now, you decide I want to be investor. Why do you want to be investor? Because you got too much money at your hand. You're not really now hand to mouth kind of guy. You worked your way up. You went to college, you slogged your butt. If you are from some competitive countries like India or China, you probably even have to go through some investment through some competitive examinations, and then you probably went to the IITs and engineering colleges and medical colleges, and then you were the proud jewel of the family who just showed up in this country and made his first $10,000 and is now itching to make it $100,000, itching to be rich. And then what you realize, you go to a party and your friend says, "Hey, have you checked out this stock? Oh, I just made so much money in it." So you just start investing in that word of mouth rumors without even knowing any concept about investing. So let's go to the basics of investing. Now, before I go deep into any of these topics, what I'm gonna do is tell you the basic concepts right in the sense, get the jargon, get these terms in your head. Okay, what is an asset class? Have you ever thought about that? Expected risk and return profiles for each asset class, what does that even mean? Diversification among asset classes and within asset class, what does that mean? What is diversification? Is it just like what your grandma said about not putting all your eggs in one basket? But can we actually quantify that? Long term perspective versus the short term perspective. So now, why is that important? That's important because you see, if your perspective is too short, like 6 months, you be putting money in the stock market? Now that's a very good question. Most financial advisors would advise you not to put your money in the stock market if your time horizon is too small, because they say at least 3 years. Now, attitudes and risk tolerance. What is your attitude? Are you the kind of guy who gets all worried and have starts having the sleepless nights as soon as the market goes down 5 to 10%? What would you do in 2008? What would you have done in 2008 when the market was down 37%? So, what is your reaction? Like, what kind of investor are you? Are you comfortable with ups and downs of the market, or does the uh, um, fluctuations in the market also give fluctuations in your head, and then you have all kind of problems? And so you just want to make sure that these things are taken into account. You got to know yourself, what kind of person you are. I mean, you don't want to be the kind of guy who cannot even take a dump because the market is down 10%, because it makes you basically constipated. So you don't want to be that kind of guy. Now, rebalancing. What does rebalancing mean even? Have you even heard of the term rebalancing? So we'll go to that thing too. Now, before I move to the asset class, what I want to do is go and think about all the things that I talked about until this far, and then think deeply about it, and then see what kind of investor you are. What's your risk tolerance? What's your attitude to investing? What do you know about things like risk and return? When people say more risk is more return, is that really true? Think about these things. Think about the concepts like fee based versus um, commission based financial advisors. Getting an investment acumen, okay, that's fine. That's probably self explanatory. So now coming back to um, stocks versus bonds. What is a CD? What is real estate investing? So hopefully you will churn these ideas in your head and you start to get some idea of where to go next. And then I will come back in the next slide, and then we'll talk about what is an asset class. Bye for now. Have a great day. See you soon.